Hello everyone, welcome to KLI Market Commentary for March 2024. My name is Avajit Puri and I am part of the team managing fixed income investments at Kotak Life. Today I plan to share my views regarding the recent macro developments and the backdrop in which the Monetary Policy Committee will be announcing its resolution next month. After more than 500 basis in cumulative tightening in global policy rates and tighter financial conditions, the global macroeconomy continues to remain resilient. Economic growth remains robust as evidenced by labor market strength. On the other hand, global inflation continues to moderate, led by slowing wage inflation led by higher labor supply. With disinflation underway and economic growth robust, the likelihood of a hard landing has receded. But how the future unfolds will ultimately depend on when and how much action global central banks undertake to limit the impact of elevated borrowing costs. In this context, the recent communication from the Fed as well as the ECB continues to build in expectations that monetary easing may begin from June 2024 onwards. Chair Powell has in fact indicated that the Fed is not very far from having enough confidence that inflation will sustainably revert towards 2%. In fact, the recent ECB meeting as well has built in greater confidence that inflation will trend towards 2% by the second half of 2025. But all is not that simple. Expectations of monetary easing has resulted in looser financial conditions. In fact, the recent CPI print in the US surprised on the upside and led to market speculation that inflation may not sustainably revert towards 2%. The last mile of disinflation has always been tricky, and this is where the challenge lies. On the domestic front, the Indian economy continues to exhibit strong growth. India grew by more than 8% in the last quarter and is poised to remain the fastest growing economy in FY 2024 as well, with GDP growth expected to be around 7%. The next few quarters will however be crucial given the multitude of risks arising from elevated policy rates as well as slowing global growth. On the inflation front, headline inflation is likely to remain at 5% this month as well and is broadly in line with RBI's projections. But one positive on the inflation front is that the core inflation momentum remains subdued and core inflation has been trending below 4% on a sustainable basis. Headline inflation for the next financial year is projected at 4.5%, and although this is 90 basis below this year's level, repetitive food shocks remain a risk. Given these factors, the MPC is likely to remain on hold and keep its monetary policy stance unchanged in the upcoming policy review. While liquidity conditions have started to normalize with the weighted average call rate now close to repo rate, the MPC may formally announce a shift in stance only when growth concerns arise or when it feels that inflation is on a sustainable path towards 4%. Coming to yields, global markets are pricing in a rate cut profile consistent with the soft landing narrative. Close to 3 rate cuts of 25 basis each by the Fed are being priced in for 2024. Indian bond market sentiments, on the other hand, have also been boosted by fiscal consolidation and front-loading of FPI flows ahead of JP Morgan's bond index inclusion. Going ahead, markets will keenly watch out for guidance from the MPC with respect to liquidity and rates. They will also be watchful of the global growth inflation dynamics and the market borrowing calendar of the first half of FY 2025. We expect the 10-year Indian government bond yield to trade in the range of 695 to 710 in the near term. Happy investing.